Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. It's just after 12 noon Eastern Time. I also want to say good morning to those of you who are joining us in the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. Of course, good evening if any of you are joining us from across the pond in parts of UK or parts of Europe. And good early morning if any of you are joining us from parts of Asia or Australia. Today we just want to do a quick presentation, probably only going to be about 45 minutes long or so. We want to talk about what is possible with the radioactive trading techniques, a look at what we will attempt to adjust and attempt to maneuver after we open the protected position. All right, well, welcome. Many of you, of course, might be familiar with the concepts of radioactive trading. To put ourselves in a properly structured position, we look to open a stock and at the same time buy to open a put option that guarantees that we can't lose more than about 4 to 6% on any one position. After this protected setup is initially entered, we look to apply 12 different income methods to reduce risk, generate income, and even bulletproof the position. And what does it mean to be bulletproof? Well, here are the 3 steps that is the goal of the accomplishment, what we're looking to accomplish with a radioactive trade. On the left, of course, we start with a position that has a very controlled, limited risk. Much better than a stop order. We're guaranteed that we can't lose more than 4, 5, or 6% on any one position. After that position's open, we're going to look to apply what we call income methods, common adjustments that you're familiar with, done in the context of a protected position to lower that red level, to take that risk away, and then eventually we can have a position where there's no risk to the downside and still leave ourselves with an unlimited upside profit potential. This is what we call being bulletproof, where we can go through earnings or any market uncertainty, realizing that we have a guaranteed profit if the stock collapses, and still have an unlimited potential profit to the upside as well. Now, if this is your first time joining us for one of the radioactive trading presentation, let's give you a real quick history. The radioactive trading techniques were developed by Kurt Frankenberg about 15 years ago. He had saved up some money and spent a few $1,000s on a weekend course to learn how to trade covered calls and spread positions. Well, after going out on his own and following his guru's advice, after the course over a 2 to 3 month period, he essentially lost all of the savings that he had set aside following his guru's advice. But he didn't give up. He did realize that the money just didn't disappear. It went somewhere else in the market. So rather than do a covered call position, which caps your upside but leaves open risk to the downside, or spread positions, which might even have an 80 or 85% probability of success, but take on a 10 to 1 or 15 to 1 risk-reward ratio, he decided to look for a better way. And that's how he developed the initial radioactive trading. Yes, it was a strategy that's already known as far as a married put, or what you might know as a protected put position, but he decided to take the concepts that are important to profit with a covered call, a spread trade, or any other option strategy, and realized that the standard idea of a married put or protected put wasn't really putting the odds in your favor. So here's a standard setup of a radioactive trading position, the way we'd open any new position from scratch to put ourselves in a properly structured trade. This trade is actually from one of the Fusion portfolios. Fusion subscribers will be able to see Ernie Zarenner's trade, the president and founder of Power Options. They'll be able to see his radioactive trades. Greg Zarenner, of course, the vice president of Power Options, he posts his radioactive trades, and you can see my radioactive trades as well. But on August 23rd, 2016, Greg opened a new radioactive trade by purchasing 100 shares of BABA at $96.38. At the same time, he bought an April 97.5 put, so it's almost 8 months out in time. And he ended up paying $9.30 for that position. Now, this does mean that his total investment into the stock plus put combination was $105.68. But even in the absolute worst case scenario, if the stock falls to $90 or $85 per share, he's guaranteed to get 97.5 back. Purchasing the put option gives him the right to force someone, of course, to buy his shares of stock at that price at any time. Or he can choose just to liquidate the position if it's not going in the desired direction. Now, this does mean that the maximum risk on the position is 818 or 7.7%. So here's a standard profit and loss chart for the BABA position. And of course, I want you to focus on where the stock is now at 92.83. This screenshot was taken this morning. So the original setup, remember, would have been an investment for 100 shares of 10,568. But in the absolute worst case scenario, again, even if the stock collapsed to $60 per share or lower, he's guaranteed that he can't lose more than $818 of that $10,568 investment, or 7.7% on the position. Now, let's talk about this right off the bat. I'm going to write some numbers here over on the side for you, and we're going to take a look at something. Now remember, when he opened the position, he bought the stock at 96.38, and he paid $9.30 for that 97.5 put. Okay, so there's the total of the $10,568. Now, is the break even 105.68, the total investment into the position? Well, yes, you can see that here on the chart. But that's if and only if this position was held all the way to April expiration, no adjustments were made on the position, and if there were dividends being paid, we somehow refused the dividends. And that's the only time really the break-even comes into play. The way we set up the radioactive trade following the rules in the blueprint, we do have a delta positive position, right? And the put option probably only has a delta of minus 0.5, minus 0.55, maybe minus 0.6. So if the stock moves up 50 cents the day after the trade was opened, the put would drop only maybe 20 or 30 cents. There would still be a profit on the position. Now the curved red line here, of course, shows you the profit and loss at the halfway point at 2017 for when I took the screenshot today. And notice the break even is a little bit lower. But when you open a radioactive trade, 10 days from now, 15 days from now, the break even would probably only be at about $97.50, maybe $98 per share, nowhere near the 105.68. Because the put does not decay one-to-one with the stock. And I'm not down $9.30 when I open the position, nor am I down the $8.18, the time value or the true risk on the protected setup. If I open this position the same time Greg did on August 23rd, and then I said to myself, well, you know, maybe I don't like this trade, I could have immediately turned around and sold to close the stock, let's say at 96.30, and I could have sold to close the put for about 9.25, maybe 9.35 if the stock has fallen. All you're risking when you initially open the married put position is the bid-ask spread of the put option. You're not immediately down $818. You're not immediately down the $930. As the put doesn't immediately go to a value, you're not, go to zero. We can still manipulate that many different ways, and that's one of the things we're going to look at today as well. So although we paid extra premium to get into the position, we did that to control our risk better than a stop order. If Alibaba gaps down 20% the day after the trade was open, we'd still only be risking 7.7%. In fact, since we bought the April put option, we set it up correctly, it would still have a large amount of time value. Even with a 20% decline, we wouldn't be right at intrinsic value. We could sell to close the put and sell to close the stock and might only take a 5% risk. But if you open just the stock by itself, paid $96.83, and set a 10% stop loss, but the stock gapped down to 80, you don't get filled at the 10% loss. You get filled at whatever the market is offering when it opens. So you'd get filled at $80 or $75 per share, and you'd realize that 15, 20, or 25% loss on the position, where here we have a proper setup. And yes, we did pay more into it, but we're not losing that amount on the position. All we're risking is the bid-ask spread. Now, this is a married put setup. It's nothing new from what you may have already read at your broker or at an introduction to options book, or maybe online for basic options scenarios. But we do it a little bit differently to stack the market odds in our favor. It is a married put, but it's done to, when we buy an option, we want to be buying it further out in time. The option that's 6 months out in time is not going to be 6 times the cost. You're going to have a lower cost per day by buying further out of the money. Most married puts or protective puts are taught as buying a short-term cheap put that costs less but takes a higher risk. If I had purchased Alibaba at 96.38 on August 23rd and bought, let's say, a 90 put, $6 below the current price, and let's say I paid $1.50 for it for a 1 month out put, well, I did only add $1.50 of cost into the position. But remember, the insurance doesn't kick in until the stock fell to $90 per share. So the $6.38 plus the $1.50 would put me at a risk in about the same I had with the married put position, the RadioActive trade buying me further out in time. And that's only for 30 days. If the stock stays the same and stays just above 90, that put expires. I added $1.50 to my cost basis. Now I have to buy another put a month out to protect the position and pay another $1 or $1.50. 8 months down the road, we would have put in much more cost into the out-of-the-money puts if we continued to buy and buy and buy. We avoid the rapid time decay. If I bought the 90 put for September on August 23rd, over the course of 15 days, if the stock stayed right where it was, that would go to zero. Buying the in-the-money put and buying it far out in time means we have a much slower time decay working against us. Remember, we paid less per day to get into the position. Okay? And we also pay less time premium than if we would have bought the at-the-money. That's just the at-the-money bell curve, where those of you who are trading options and selling premium know you want to sell at the money to maximize your time value. But when you're buying, we want to buy in the money or out of the money to pay the lower price. So what is possible after that initial setup? Well, we've entered into a trade where we have an unlimited upside profit potential and a controlled risk that is guaranteed to only single-digit percentages. And we still have the opportunity to do all of the regular adjustments you might be using in your account right now, but without adding any risk into the position. And what do I mean by that? Well, those of you who are trading spread trades, when you enter a new spread, you might be looking to make an 11% profit. Let's say a 50-cent net credit off of a 5-point spread, essentially 11% return. You might be out of the money, so you've got a 75 or 80% probability of that spread expiring worthless. But that also means you're taking a 10-to-1 risk-reward ratio. We're going to show you a little bit later on how you can do a spread trade that you might do in your personal account without adding any risk. But I'm getting a little bit ahead of myself. Let's go ahead and talk about what you're trading now. I want to know what strategies you're trading right now and how that's worked out for you over the last 12 months or so. So let's just take a look here. Let me go ahead and launch our first poll. What strategies are you trading right now? Are you mainly looking at generating premium, maybe on a weekly or monthly basis with covered calls and naked puts? Are you looking at buying calls and buying puts, speculating on market movement, or maybe you're doing straddles and strangles? Okay. Are you trading the credit spreads? Very popular, very attractive strategy. Bear call credits, bull put credit spreads. Are you doing some of the more advanced techniques, combination strategies, broken wing butterflies, ratio spreads, calendar ratios, and things like that? Or are you currently just trading stock only? So let me know kind of what you're trading right now. Okay, I've had the poll open for about 55 seconds or so. I'm going to leave it open for another 5-10 seconds. Okay, we've got a fair amount of our audience has already voted. We've got a pretty decent split here among our 5 questions, 5 answers, I should say. All right, let me go ahead and close that poll, and let's share the results. So 6% of you, really this is probably the lowest that I've seen it recently, but that's perfectly fine. 6% of you are trading covered calls and naked puts. 12% of you are buying calls and buying put options. And the largest proportion here we can see 65% of you are doing the vertical spreads, credit spreads or maybe debit spreads as well. 12% of you are doing the combination strategies, and 6% of you are trading stock only. Okay. Now let's go ahead and hide that. And let me just ask a quick follow-up poll here. Just want to know, how has your strategy been working out for you over the last 12 months? Did you have more winners last year than losers and you made money? Did you have more losers than winners and lost money? Did you have more winners but still managed to lose? Or was your trading account about 50-50 and you were just kind of treading water? Or are you about to quit just to stop the losses? All right, so far this is pretty encouraging in the sense that no one is saying they're about to quit just to stop the losses. So that's kind of what we were looking at. Okay, Martin sent in a question. Martin has sent in a question related to the Fusion subscription. Martin, I'm going to have to address that after the webinar. I do apologize for that, but Martin is asking a Starbucks question that Kurt put together. And Kurt made some adjustments, but Martin mentioned that his short option was assigned, the stock was taken away. Now what? Now, Martin, we're probably going to look at income method number 7 on your position if you were assigned, but I'll discuss that via email with you after the webinar. I won't have time to show that today. Okay? All right, let me go ahead and close the poll and state about the, okay, one vote did come in, unfortunately. A couple votes did come in. All right, so I'm sorry to see that. In any case, 21% of you had more winners than losers and made money last year. That's great. 16% of you, we picked more losers and we lost money. And 16% of you had more winners and lost money, and you probably want an explanation. And 42% of you said you're about 50-50 and you're treading water there. You're not seeing any profits. And unfortunately, at the end, 5% of you said that you're about to quit just to stop the hemorrhaging as well. All right. So let's move on now for the time being. And, okay, there's a double thing there. What I'm going to do real quick is I'm just going to pause the screen here. I want to navigate over. We're going to take a look at something over at the RadioActive trading site. Okay, sorry about that. There we go. All right, so what we're looking at here is at radioactivetrading.com. If you click the Resources tab, you can see where you can get a 2-week free trial to power options. But also, we can take a look at the Trade Simulator tool. What the Trade Simulator tool is going to do for us is just a simple little tool that takes into account if we were doing a plan strategy. Okay, if we're looking at a trading plan, and let's say that when we open a position, we're going to look to close the position if we hit a 10% gain, our target return. But at the same time, maybe we're going to use a stop order, and we're going to set our stop order at 10%. So any position that we get out on at 10% loss, we're going to go ahead and close. And let's set our probability of loss to 50. We're going to look at a 50-50 win-loss ratio. We're going to take a starting amount of $10,000. Okay? Now, we can change the investment ratio. I'm just going to put in 50% now. So what are we looking at here? Here is a win-loss ratio of 50-50. Now at one point over here on the right, we see a string of winners and losers. Essentially, we're flipping a coin. Heads we win and make 10%. Tails we lose and lose 10%. So we take our account up and then we suffer a loss. Then we have some winners in a row. And as we go further down, we're going to see continued strings of winners and losers. Now at one point, this 50-50 win-loss ratio, we might think we have a good setup. At one point, the high value goes up to 14,000, so we're looking at about a 40% gain on our portfolio, making 10% when we're right, losing 10% when we're wrong, having a good 50-50 win-loss ratio. But over time, the math doesn't work as we expect. If you take a 10% loss on one position, you need a little bit more than a 10% gain on the next one to get back to break even. So if my first loss, let's see here, if we take a loss on the first run, which is not going to allow me to do that, okay, but let's just talk about the numbers here. If we take a loss on the first trade, on our $10,000, we take a 10% loss, we're down to $9,000. We reinvest that into a new stock position. It hits our 10% gain, so we close it, but we're not at $10,000. We only made 10% of what we had left, so we're at $9,900. If you take a 10% loss, you need 11% gain to get back to break even. Here you have a winning record of 51 trades where you had about a 62% gain, but over time, you're still at a small loss. Now, this is sort of the target return that the 10% of you, 6% of you just trading stocks may use. You may even adjust your stop order and put your loss limit down to 7%. But there were probably one or two times over the course of the year where one of those stocks breached that 10% stop in overnight trading, and you actually took a larger loss on your position. Well, let's talk about the 6% of you that are maybe doing covered call positions. A standard covered call, if I bought to open a stock today, sold to open a call, I might generate a 3% potential return if assigned, let's say for a 14 or 20-day trade. And let's say we are going to control our risk with a stop order, and I'm going to set that to 7%. And you feel that because you're generating 3% of premium on your covered call positions, that you can take a larger loss, meaning that you're going to be right more often. Even if the stock falls, let's say 2%, you're still going to have a 1% gain for the 3% premium you generated. So your probability of loss, maybe you're at a 60-40. Okay, so let's go ahead and run that. Well, that doesn't look too good, does it? Here you've got a winning track record where you're right 63% of the time, and you took 37 losses. But over the course of 100 trades, you took the first loss right out of the bat, and you never made it back up. Okay, you have strings of winners and losers, and you're right 63% of the time, but overall, you see a loss of almost 32% in your portfolio. Let me set this back to 50. It changed on us. Let's get a better winning record. Well, that's a terrible record. All right, here's another one. Here, we're right almost 70% of the time, looking to make 3% when we're assigned, taking only a 7% loss if we're lucky, using stop orders. And at one point, we do have about a 22-23% gain on our portfolio. But long term, even being right almost 70% of the time, we end up at a loss of about 8%. And that's how the math works, and that's why some of you who were having more winners and losers and still managed to lose, this is how it affects you. On a standard covered call portfolio, where you're looking to make 3% when you're right, when you're assigned, and you may even have some downside protection, but you're using a stop order at 7%, you're going to need to be right closer to 70% of the time in order to profit long term. Okay, so there's an example there. Well, there's 62% again. Okay, so here we go. So 79% of the time, almost 80% of the time, you can get a 50% return, and you only had an 8% drawdown. But you have to be right 70% of the time. A covered call portfolio where you cap your gains, and you're still going to suffer losses, even if you're right 70 to 75% of the time, you're not likely to profit long term. Okay? And those of you who are about 50-50, we're using covered calls, of course, and we're treading water from our previous poll. Well, you might be in that situation. But what are some of the other things that give us a high probability? Well, 65% of you are doing them. Right? We're looking at potentially doing credit spread positions. And what's the standard setup for a credit spread? Well, if I did a bull put credit spread, let's say we've got a stock trading at 100. We might sell a 95 put and maybe buy a 90. Okay, so we've got a 5-point spread. And let's say we generate 50 cents of credit on this particular position. Okay? Well, that means your true risk is 450. The difference in the strike price is minus the net credit. If the stock stays above 95, you keep the 50-cent net credit. Both puts expire worthless. If the stock drops below 90, you take the full risk on the position. Okay? Thomas says, what drawing software are you using? I'm sorry, it's on the GoToMeeting, GoToWebinar. I apologize if it's not clear. We can look at this using the Power Options tools, but I didn't want to go jump back and forth between the two pools, so I apologize there for sort of the sketching there. But that's kind of our bull put spread, what the position would look like. Okay. Now we know that with a stock at 100, we're probably looking for a spread position that has a 75 or maybe greater probability of expiring worthless. But what else are we looking at here? We're looking at a 10-to-1 risk-reward ratio, a 9-to-1 risk-reward ratio, and 50 cents over 450, that's an 11% return. So let's take that into account. Our target return is 11%. Now, the loss limit's tricky, because we're not going to allow ourselves to take the full loss. That can happen if there's a sudden gap and it goes below both strike prices. Okay? But let's put our loss at 50%. Now, what does that mean? That means if I opened a $4 or 5-point spread and my risk was 450, that if the loss goes to 225, I'm going to look to manage the position. Hopefully that happens during the trading day, because of course if it gaps down overnight, I may have had a winning position. I wake up in the morning and now my spread's at full loss. So we're going to set that at 50, and we're going to take our investment down to 25%. Okay, so on a $10,000 account, each bull put, 5-point spread, we'd only put in $2,500, probably about 5 contracts worth. That makes sense, right? And let's put our loss target at 25%. What does that mean? It means I'm opening a credit spread with about an average 50-cent net credit on a 5-point spread, which would be my 11% return. I'm going to set my loss limit at 50%, 225, if it blows below my short put strike price or short call on a bear call. I'm only opening positions that have a 75% probability or higher, and I'm only investing $2,500 for about 5 contracts in each trade. What just happened? I'm right 75% of the time as I was promised. I've got a winning record here of 78%. I only lost 22 times out of 100. At one point, I had a 13% gain, but at the end, I've got over a 50% loss. We're looking at a 56, 57% loss on our portfolio. And that's a standard setup. Okay, so if we run it again, we're not getting where we need to be. If we have a losing track record, 65-35 below our 75% probability of success, we're going to take a severe hit long term. Those losses pile up quickly. So let's set this to a different range. Let's put it up to 80. Okay, let's run that. Whoa, here's a problem. We had a bad track. Oh, my apologies. Thank you, Don. Don always points that out when I do that wrong. We know we can't do 78, so here you go. Looking at 80% probability, still looking to make 11% when you're right and only taking a 50% loss when you're wrong, you need to be right 87% of the time. Now, you still had a drawdown of 50%. How many of you would have stayed with a trading plan if you saw about a 50% drawdown during some point in a 12-month period? You probably would have been changing strategy, of course, and making different adjustments. But we were looking for positions that needed to be right 80% of the time to profit long term. Here we see a good track record being right 87% of the time. Here's one at 85. There's still a winning one at 84. I'm just trying to see. There we go. But how about this? This is what I wanted to illustrate. Those of you trading credit spread positions, this is the lie of leverage. This is the lie of that 10-to-1 risk-reward ratio, even though you have an 80% probability. Looking at a standard spread combination, 11.1% return, 80% probability, putting in about $2,500 per trade. Even if I'm right 80% of the time, I can still see long-term 35, 40% loss in my portfolio. What I'm trying to illustrate is those of you doing credit spreads or just thinking about getting into credit spreads, when someone, a guru out there or someone says, oh, well, they're great because you can use margin, you don't have to put up the capital as you would to buy the stock or do anything else, and you can have probabilities in the 80% range. What we just saw with the common setup is if you're doing credit spreads and you're looking at 80% probabilities, you actually need to be right almost 85 to 90% of the time to profit long term. And that's where some of you were probably behind the eight ball, where you had more winners than losers and still lost money. Well, so we looked at a standard stock portfolio. If we looked for a 10% win, 10% target, of course, and 50-50 win-loss ratio, and we would have lost money. We looked at the covered calls and saw how you need to be right about 70% of the time to profit long term. And we've shown with the spread trades here that you need to be right as well, probably closer to 90, 87, 90% of the time to profit long term, even looking for positions with an 80% probability. Let's take it back to a 50% probability. And let's take it back to a 50% investment. And let's say that we're going to look for a little bit higher return. Let's say about 6.5% or so. Actually, I'm going to put it up to 7. And we're going to put our loss limit at 4.5%. Now, here we have more winners and losers on our portfolio. 55% of the time we were right. We almost doubled our portfolio. We only had a drawdown of about 2%. And long term, we still had a good win. Okay? There's one of 53. How about this? With a setup where you potentially make 6 or 7% returns on your positions on average, and you control your losses to 4.5%, even if you're wrong more often than right, you can potentially make money long term and maybe only suffer a small drawdown of 5 or 6%. You can't do that just by buying stocks and using stop orders, because you're going to get burned 1 or 2 times. And there's no guarantee you're going to hit that 10% target return that you set. Covered call positions, we saw that with the 3% capped upside, even if you're rolling or adjusting, trying to control your risks to 7% or less on your position. Well, you still needed to be right about 70% of the time. Spread trades, we saw that one ratio where we ran a scenario, and after about 35 trades, we were bankrupt because we had more losers than winners. Here, with the proper structure, you can actually be wrong more often than right and still make money. But that's not the goal. We still want to pick winners more than losers. So what I want to do here is I'm going to go back up to the top of our page. I want to go to the track record. And here, we set the 7% target return, a 4.8, 4.5% loss. Just want to go to the track record real quick. I'm going to click on mine. This is since 2008, the radioactive trades we posted for Fusion subscribers. So my average win is 77.1%. My average loss is 4.7%. And I've been right 60% of the time. Okay, now this is just that same calculation. These aren't my actual numbers, but the same calculation if long term. I started with $10,000. Kept my average wins to 7% and my average losses to 4.7%, that after 100 trades might see a drawdown as much as 7%, but overall the portfolio would show phenomenal gains. And that's at 60-40. 50-50, this would still be a winning ratio because we're properly able to control our risk and still take advantage of further upside as well. Okay, so that's just one of the illustrations we want to see. And if we put in, if we go back a couple, let's put in a more reasonable return. Let's say that we did only 6.5% gains and took only 5% losses. Okay, not even as high as we were looking at with the stock of 10% target price, but we're controlling the risks, still a 50-50 win-loss ratio, but being right about 50-50, we're still showing a profit. Okay, I want to find a loser. There we go. Even being wrong more often than right with a more reasonable target return, average wins on trades of 6.5, but guaranteeing not losing more than 5%, which is better than the assumed stop order, assumed insurance of a stop order. You could potentially be wrong more often than right and still make money. That is the radioactive trading concept in action. How you don't have to force yourself to try to be right 80 to 90% of the time. Sure, we like to use technical indicators. Sure, we like to look for positions that match our fundamental and technical screens, as we talk about in the blueprint as well. Of course, we like to look for those positions, but at the same time, the market dictates what we're going to do. Okay, we can't always be right 60 to 70% of the time. Okay, But even if we have a bad track record, the proper structure that we saw of the married put position, controlling risk first, we could be wrong more often than right and still make money because of that guaranteed exit. And remember what we talked about at the beginning, this 7.7% loss that we took would be realized typically only at April expiration. The position was open in August, and only if the stock was trading below 97.50, and only if we had made no adjustments and accepted no dividends. If in the first 60 days the position's not going in the direction that we want, and we can see that right here, we can close the position and take nowhere near that full loss on the position. Okay? I'm not going to have the time, Ben, because we want to see something else, but here's the key. I'm going to send this to everyone. Ben asked a question, and he says, Mike, in your simulation, 50% account per trade seems rather high. Well, okay, but the only one I used 50% for was using covered calls on a $10,000 account, so each covered call would have invested $5,000, the long stock, and of course the married put position. So if we were just using $10,000, we would put probably $5,000 in each trade. That means you're trading stocks close to around $50, which is reasonable for a long stock, covered call, and married put, radioactive trading. On the other one, we lowered it to $2,500. The reason why I did that is because I know on average, most of my spread traders at Power Options are trading around 5 to 7 contracts of each of their credit spread. So in a $10,000 account on a 5-point spread, that would be $2,500. Now, of course, you can show the impact of varying that. Oops, sorry, I didn't want to go one ahead there. All you have to do, just go to radioactivetrading.com after the webinar, so we got some other things here, /resources.asp. Okay, so if you go to radioactivetrading.com /resources.asp, that's a public page there, Ben, and you'll be able to plug in your numbers of what your target price is, your target return, what loss you're looking to control to, and then you can change the investment amount, the probability of loss, put in the numbers for your trading plan that you're doing right now, and see how you come out after 100 trades and see if that does better than what we saw with the radioactive trading setup, with even still being right only 50% of the time. And yeah, I put in 50% investment because I'd probably be trading stocks around the $40 to $50 range. When I first started trading radioactively, I was trading positions in the $15 to $20 range, but I've expanded that over time as well. Now, before we move on here, I'm going to show you what is possible and what we do look to accomplish with the radioactive position. But first I want to know, think about what we just showed with the resources tool, with that trade simulator tool, radioactive trading. If you've taken all your losses from last year that you incurred, but you kept them to single digits, how would that have changed your portfolio over the last 12 months? Would keeping all of your losses to 5% or less not have changed or not have helped? Well, you still would have lost money, but lost much less and still had more to trade going forward. If you kept all of your losses to less than 5% or so, would it have turned your losing year into a winning year? Nor would you have saved over $5,000 or more if you had just kept all of your losses to less than 5% on any position. All right, we still have some votes coming in, and I'm going to leave this open here for about another 10-15 seconds. If you haven't voted, I encourage you to do so. Okay, folks, let's go ahead and close that poll now. I'm going to share the results. Looks like the ones stopped coming in. So 36% of you would have lost, but lost much less. You would have had more to continue trading. An even number, this would have turned a losing year into a winning year. Okay, so that's a game changer, isn't it? You lost last year, but you'd have won had you just limited your risks to less than 5%. 27% of you said that you would have saved $5,000 or more in your portfolio. Nobody. No one in attendance today. It's bouncing between like 45, 43 people and going up and going down. But no one here today who answered the poll said that controlling their losses to that guaranteed 5% of less would not have helped their portfolio, would have helped everyone on attendance today controlling their risk. All right. Well, let's go ahead now and move on and see what's really possible with the radioactive trading technique. So remember, on August 23rd, we had the initial BABA position with a risk of about 7% or so. So it was right around this time frame when Greg opened the position. Okay? And we kind of took a wild ride here, didn't we? Over the next month or so, the stock's trading at about 110, dips back to 105, comes back up, and falls back down to just above the entry point, and then continues to fall to about 7-8% below the entry point. Now has come right back, but is still, $3, $4 below. Okay, so naturally, when we look at this position, we see a lot of opportunities. Okay? But I could have sold a call here and then sold a call here and so forth and reduced the risk on the position. Let's take a look at September 27th, about a month after this trade was opened. BABA was trading around 108.25. Now remember, our risk was $8.18 total, or 7.7%. So on September 27th, we could have sold an October 14th call, 17 days out, the 110 strike slightly out of the money, so you don't go in the money and risk getting assigned, and that would have been about $2. So we've taken down the risk to about 618. We've dropped it to maybe about 5.6, 5.7% of our investment. Okay? But what about that second asset that we own? That put option that we paid $9.30 for, which the argument is a wasting asset, and it increased our cost basis too much, so we can't profit on the position until the stock's above 105, which it is now, of course, on September 27th. But is it really a wasting asset? Let's take a look. As BABA moves up, and as would happen with any stock, the put did decline in price, but it did not go to zero. The April 97.50 still retained a lot of time premium because it's still about 7 months out in time. But as this put declined in price, all of the other puts declined in price as well. So there's an advantage there of doing one of the 12 income methods. Income method number 4, rolling the put up to lock in some of the unrealized gain we have on the position. So using our second asset, which cost too much, made it so we'll never have a profit unless the stock hits break even, which we've already debunked, and is a wasting asset, we're able to sell to close that April 97.5 put for $6.30. And at the same time, we can now buy a higher strike, an April 110 put for $11.90. Now, this is done at a debit. Although this is an income method, this is the only income method done at a debit. So I'm going to pay $5.60 to move my insurance, to move my guaranteed exit up in price. So remember, our old cost basis we had on the position of 105.86 or so now goes up to 111.28. So wait, this is going the wrong way. I'm adding money to the position. But notice that we've also increased our insurance to 110. When we initially opened the put, we had a time value of 818. That was the true risk. Now that the put is deep out of the money, it doesn't go to zero. We still had a time value. We still had 630 of premium available on the position. So by adding 560 into the trade, we increased the cost, but we also increased the debit, the guaranteed exit, by $12.50. So now we have a reduction in risk of $6.90. Okay? So, did we add a debit? Yes, but we did it for the guaranteed higher payout. Now, some of you might look at this and say, no, you lost $3 on the put. You didn't gain $6.90 on the position. Okay, well, let's look at the math a different way. Remember, we bought the April 97.5 put for $9.30. On September 27th, we're going to sell it for $6.30. Okay, that's a loss of $3. Remember, the stock's trading at 108. We've gained $12 on the stock to lose $3 on the put. We could have liquidated right now on September 27th, my apology, for a $9 gain on the position. Okay? But then we used Old English and bought, sorry about that misspelling there, the April 110 put at $11.90. So the total put transaction was $9.30 plus $11.90 minus $6.30. So we do have a total cost of $14.90 into the put transactions alone. And that's, by the way, just one adjustment. Similar to just rolling a call, we just rolled the put. We can do it as one transaction, right? So how would that look? Remember, we purchased 100 shares at 96.38. Taking into account all the prices of the puts at 14.90, well, that still puts us at a cost basis of 111.28 total. And so our guaranteed exit is 110. So now the new risk on the position is 128, or 1.1%. Now again, keep this in mind, the stock's at 93. So here's how the new married put would have looked on this much more attractive profit and loss chart when the stock was trading at 110. Okay? But in this scenario, we've closed this gap. We've closed the gap on the position. Remember, it was originally $818. Using the put, adjusting the put, we were able to cut that risk down by $690. So the remaining monetary risk is only 128, or 1.2% on our position. We've canceled, about 6.5%, exactly 6.5% of the risk with one adjustment after 1 month. This red line is getting shallower and shallower. Okay, we're getting to a point where we may be able to cancel all of the risk on the position. Oh, and by the way, look at the risk now. It's at 128. Remember what we saw before? We could have, if we wanted to, instead of rolling the put and reducing our risk by 690, which put us in a very strong position, remember we could have reduced the risk by $2 by selling that October 14th call. Well, manipulating the put using that second asset that we purchased into, which is not a wasting asset, we weren't down $9.30 when we opened the position. We didn't have to generate $9.30 of premium to realize a profit because the put doesn't decay one-to-one with the stock. We're able to reduce the risk by almost more than 3.5 times more by using a different adjustment than just commonly selling a call, which might be your first reaction on a married put position. But we still could sell the call, couldn't we? So later on the position, what Greg decided to do was sell to open the November 110 call for today's expiration. This is on October 19th at 164. Didn't get the $2 we would have seen for the October call back then, but he was still bullish at the time. But by selling the call at 164, he reduced his cost basis from 111.28 down to 109.64, still has a guaranteed exit of 110. So now the new risk on the position is minus 36 cents, or minus 0.3%. Negative at risk means a bulletproof position. All right, so here's what we see now when the position was opened on October 19th. There is a capped gain, but just like any other covered call, we can adjust that if it starts to move up in price. But even if the stock collapsed, which it kind of did, but even if it goes further, drops to 75, 70, guaranteed a small profit of 0.3%, but still have the advantage of having upside profit potential. So here's here's a different risk-reward ratio with a potential max profit of 7.4% with a shorter term expiration, okay? So what do you do after today's expiration, Chet? Chet just popped that question in. Well, that's not my decision. That's Greg's decision, okay? This is his trade. And sure, after the call expires worthless on Monday, he's going to reevaluate the position. There are 3 things I could do on this right now, personally. I could adjust the put the different direction and still potentially keep a bulletproof status. I could maybe lower it down to the 95 put, still maintain a bulletproof status or a small risk, and be able to do other adjustments. I could do what's called income method number 12, depending on my sentiment check going forward. And if I feel that the stock's going to continue to fall, I could be able to profit in either direction on the position as well. I could do with the stock, you're right, with the put at 110, I probably wouldn't do the bear call spread income method number 6, but I could consider that as well, even with the stock down to $93 per share. Okay? There's different ways to manipulate it once this call expires worthless. Greg hasn't bought it back. It's only worth about 4 or 5 cents. He hasn't bought it back because he doesn't feel like paying the commission, which is perfectly fine. I do that a lot too. So let it expire. Fusion subscribers will probably get an update on the position maybe in the next 2 weeks or so, depending on what Alibaba does after then. Or Greg might see an opportunity to do an adjustment next week, Monday or Tuesday, where he could lower the put but still keep a bulletproof status on the position. Okay, there's a lot of opportunities here, and being bulletproof gives me that opportunity. But even if there was still 4% risk here, Chet, I still might be able to do 3 or 4 potential adjustments. And that's sort of the advantage of having 12 different income methods, because you have more variety, more tools in your toolbox than, say, just selling to close a stock, buying another 50 shares, buying another 100 shares as it moves up and down. Rolling down the call, rolling up the call, letting the call expire for a covered call transaction. Okay? You have more tools available to you to manipulate the position. Now, not every position is going to be bulletproof, but this is what's possible. And as we kind of just reviewed with Chet, today the November 110 call is going to expire worthless. The position still has the unlimited upside on the trade, and you have a guaranteed profit to the downside, which is small, but remember, we've been in this stock the entire time, since August 23rd. The stock's down 3 points from when Greg got in, but he's guaranteed a profit. Now, could you have traded this position as a covered call and be at break even right now with it below your cost basis? Well, the stock's bouncing around 93. The cost basis in August was 96.38, so I'm sure you would have been able to generate $3 in premium. But how much would you have paid to roll? Okay, think about it again. I know only 6% of you are doing covered call positions, but let's say you entered here, that 96.38. And let's say you were an out-of-the-money trader and you sold a 100 strike call for somewhere in September expiration, okay, in here, maybe 2 weeks out, maybe the standard expiration. Okay, so the stock went up. It would have been out of the money, so maybe you got a 4% return. Okay, well, if you didn't roll the position, when it went above 100, you might have paid more to roll it to the 105. And then it breached 105, you would have paid more again to sell the 110. Now as the stock started to fall, you might have rolled back down, but remember, you increased your cost basis here probably up to a range of $101, $99 per share on the stock by rolling the covered call. Then as it declined, now you're rolling down, but you've got a cost basis of, let's say, $99 or $98. You're selling a 100 call, which still looks good at a lower premium, but then it continues to fall. Let's say here you dropped it down to 97, and you're selling a call and generating another $2, and now you're down here. So at this point, you might be at break even. But remember, even if you took assignment and then bought back in, you're paying a higher price. If you rolled the call, you're paying a higher price. So you probably might be at just break even, or at a little bit of loss most likely, by rolling the calls up every time it went to the next strike and the next strike. And let's be honest, most of us doing covered calls, if we bought the stock at 96.38, we probably would have sold the 95 or the 97.5 if it was available to get the best time premium. And we would have had to roll that when the 97.5 when it breached 100, rolled again, and then started rolling down. By this point, we probably added at least $6 to $7 into our cost basis, had a cost basis of around $103 per share. If you did bull puts, you're looking really good. Okay, let's think about that. If I was bullish on it, and we are, it's neutral to bullish position, maybe we opened that 95.90 spread we were talking about here, okay, for a couple weeks out, and that would have expired. And then with the stock trading up here, maybe we did the 100, let's say over here, maybe we did the 195, great. Still doing its thing, so right here we would have done the 100 and the 95, but somewhere around here, breached it, we probably would have closed the position and rolled down to maybe the 95.90 going forward. Done another 95 to 90 here, and now we would have had to close it, and this would have been that $4.50, $4 loss, or close to it. Let's call it $3.50. Okay, so maybe we've taken the $3.50 loss to close the position and rolled down to your $90.85. Well, that's 1, 2, 3, 4, 5, 50-cent net credits at $2.50. You're still at a $1 loss. Okay, these aren't the actual numbers, but you can see how this would have played out. Doing bull puts over this time and rolling down, this one would have been a big loss here. When it came down, you would have had to close it, probably not for the full loss, but for a reasonable loss as well. We've only taken in 50 cents. Remember, we looked at that 50 cents on a 5-point spread, the 11.1% return, probably an 80% probability. So now you're down $1 even, and you sold another out-of-the-money one, so now you're down 50 cents. Not too bad, but you haven't made anything ahead. Let's talk about this too. 1, 2, 3, 4, 5, and maybe we'll call this 6 spreads that look like they've made their profit where you didn't have to adjust 6-to-1 win-loss ratio, and you're still down potentially 50 cents based on the prices that would have been available. Okay? Whereas we're in a position where we're guaranteed a profit, even though the stock's trading well below our cost basis, guaranteed a profit of 36 cents. You know, it doesn't seem a lot, it's only 0.3%, but it's a bulletproof position with no risk on the trade, even in changing markets. Likely would have performed better than weekly or 2-week out bull put credit spreads, rolling and adjusting a covered call position. Even though we had a nice bullish run and then a pullback, probably have a better gain on the radioactive trade in the married put position than we're seeing right now with any of those other 2 bullish strategies we already talked about. Okay. Now, I can work numbers later, and I probably will. I'll probably post a blog sometime next week that shows the actual numbers of what I might have done had I traded this as a bull put or as a covered call using a standard trading plan as opposed to where we stay now. But that's the idea, not only behind the protected position, which we already saw using the trade simulator tool that stacks the market odds in our favor, without even talking about the income methods that can put you in a position to bulletproof the trade, okay? But that's the advantage of having 12 different ways, 12 different tools in your toolbox, because some of these are best used if the stock moves up in price, as we saw, 2 adjustments on the BABA trade to get the position of bulletproof status. Some are best used if the stock moves down, which our Fusion subscribers might see Greg make an adjustment on later next week or the next 2 weeks if BABA stays in this 93 to 95 range, even though he's holding the 110 put out to April. And some, for example, the gentleman that asked earlier, Martin asked earlier about the Starbucks trade that Kurt has been posting. Well, now that he's been assigned the position and Starbucks is maybe just treading water, there are income methods, adjustments taught in the blueprint that you can use, even if the stock is stagnating in price from when you first open the position. Very quickly, I want to take a look at a couple of other things in the open trades and the track record to also illustrate what's possible. And I do have a couple questions I need to address from Ben, one question from Ben and one from Jeremy, and I'll get to that in just a moment. But let me go back to radioactive trading for the time being. Okay. And here in the radioactive trading, I want to go into the Blueprint and Fusion tab. Okay, so this is what our Fusion subscribers see. I'm going to go to the open trades. Just ignore all that. And I want to take a look at Ernie's position on Hewlett-Packard. Now this one, again, doesn't look like it has a very high return. Well, you could liquidate right now for a 3% gain after a little bit over a month, but it's a bulletproof position. And what I wanted to show you is that originally, Ernie opened this position when the stock was trading at $15.10, and he bought the May 16 put for $1.95. There's his controlled risk of 6.2%. Okay? Now, on 10/19, I'm sorry, this is on September 22nd, so less than a month later on 10/19, Hewlett-Packard had dropped from 15.10 down to 14.13. Now, it doesn't look like a big deal. It's only a $1 drop, but let's talk about percentages. That's a reasonable percentage. Ernie actually did a different adjustment, which just changed his risk a little bit, but he was lowering the strike price with the stock at 14.13. He now has a 15 put, and then as the stock recovered and moved back up, he did the same thing that Greg did, moved the put back up, manipulating that asset that cost too much money, puts us too far behind the 8 ball and is a wasting asset. He did 2 moves to manipulate the put and end up in a position now that is bulletproof. The negative at risk bulletproof position still has unlimited upside profit potential and will be able to do other adjustments on the position going forward. Now I want to go to the track record again. I want to show you one of my favorites. What about stocks that just go terrible? Well, if a stock dropped 50, 60%, you don't normally see that. Hopefully none of you fell into the dry ships loop over the past 5 days. I shouldn't say that. I didn't this time, but years ago, that was one of my favorite stocks. I wrote it from 60 up to about 120. I'm sorry, 60 to about 110 over a 3-month period. closed out and the stock kept going up. So I bought back in at 118 and wrote it down to 80. That was over a longer time horizon than 5 day, but we've seen how volatile that has been, okay? But hopefully none of you got caught in that trap. But do you see stocks that fall 60, 65%? Yes. Maybe not all at once, but over a course of time. Why would anyone stay in a stock and be long a stock the entire time after it had a 20% drop, then a 10% drop, and a 30% drop all in a 2-month period on a position? Why would anyone stay in the stock long term that's just going completely against you? And it's because, well, here's that position, the Iconics brand. Icon, one of the, that's strange. I apologize, ladies and gentlemen, there. I'm sorry. There we go. Okay, so there we go. There we go. Thank you. So I'll go back to that. I apologize, folks. But here's the Icon position, ICON. Got into Icon originally with a cost basis, $36 per share. Bought an August 40 put. This was back in 2015. And the stock just dropped. So when I closed the position, let's see, Icon was at $12.25. It had dropped from, over a 6-month period, had dropped from $36 to $12 per share. So that's the 66% loss. Using the 12 different income methods, income method number 9 and then income method number 12, we were able to get a 4% profit, being long stock the entire time, with, of course, a 65% decline. I could have done much better on this position, actually, but I was just learning the new income method number 12 from Kurt. I think someone wasn't able to see us. Let's go back here. I wanted to go this trade, Hewlett-Packard trade again from Ernie. Opened originally at 15.10. Made one adjustment on October 19th. And then on November 14th, made another adjustment using just the put. Adjusting it one way and then adjusting it another way. You know, the wasting asset that costs too much money to get to a bulletproof status on the position. And look, the stock was at $16.16 when you made that second adjustment to bulletproof the trade. Well, you originally got in at 15.10. So yeah, it's $1 above, but with 2 adjustments, he was able to bulletproof that transactions. Okay. Stan says, how do you pick the likely stocks? Well, on our Fusion subscription, we do offer a tool called the RPM report. And these are the trades that match the rules in the blueprint. What we do to look for stocks and the combination of the put. That's what's described in the blueprint, not just the adjustments off the position, but what to look for in the kind of stocks you trade was work for Kurt, myself, and Ernie. For Kurt over the last 15, 16 years. For myself and Ernie over the last 8.5 years, since end of 2007, beginning of 2008, when we picked those positions. You can also use the search on power options to identify a trade. We plugged in the default radioactive criteria that we use for selecting stocks. You still want to do some research and analysis. That's what's also talked about in the blueprint as well for picking the right stocks. We have the tools available, though, for you, Stan, to pick the positions. The blueprint doesn't just talk about all these different adjustments and limited risk income methods that you can use. It's the full structure of the radioactive trade from beginning to end. Okay, that's what's available in the blueprint. All right, now, before we go forward, I think I just want to ask something real quick. Let me just see here. Oh, I'm sorry, I apologize. Let's go this here. So what do you think about the idea? I showed you really 3 income methods today. Well, I showed you 2, but there was kind of a third in there in the Ernie portfolio. And I did mention a 4th one, income method number 12, that I used on the Icon position to lower the risk. What I want to know is, what do you think about having 12 different ways to adjust a protected position on your portfolio and to be able to potentially lower that initial already low risk and maybe bulletproof the position as well? Not every position is going to be bulletproof. Right now, about half of Greg's trades are bulletproof. I've got a position on Foot Locker today, which is below 70. It's only about 4 or 5% above my cost basis, but today it's going to be closed for a 10.2% gain. The stock could drop 10 points today, and I'd still make a 10.2% return on the position. We're going to close that position today for the 10% gain. All right, so let me go ahead and close that, and I'll share the results with everyone. All right, so 13% of you said that might be too complicated. The great thing about this is you already know most of the strategies that are used in the blueprint. I know that some of these terms I'm throwing at you might be arcane, income method number 12, income method number 4, but they're all adjustments that you already know how to use. You just have to look at it in the context of a nested trade, of the protected position. Income method number 1, we showed selling a call, just as you would to do a covered call or create a collar on a married put position. Income method number 6 is a bear call spread, done in the proper context. You already know the setup. You're familiar with the setup as well. Okay? And it's all discussed in the blueprint. And every section of the blueprint, of course, we talk about all 12 income methods, the initial setup, and it's approached as though you might not know what each of these strategies are, but it's discussed with the correct terminology and shown in the context and what you'd look to accomplish. 13% of you said, I can't imagine using more than 1 or 2. No problem. Having the advantage of 12 is very beneficial because some situation you're not prepared for might come up, or it might not. I'll be honest with you, I've watched him for years. Right now I think the only income method Ernie uses on a regular basis is income method number 4, which we saw today, rolling up the put, the income method number 9 he did on Hewlett-Packard, and income method number 1, selling the call. I dabble into those, plus 4 is my favorite actually if things work out right, but I dabble into those, but also 12, 6, I've had great success with 5, other income methods. 13% of you said I only use 1 or 2 on my own strategy. I would love to see more 12. That's great. And 63% of you say, where can I learn all 12? All right, well, let's go back here. The blueprint discusses all 12 income methods. It's a text, a full text, 250 plus pages, where you learn the proper technique for the initial setup, with the do's and don'ts. There is such a thing as taking on too little risk and hedging yourself out of the position, obviously. And there's also such a thing as taking on too much risk, which is why most of us are here right now. It also discusses all 12 income methods, when to use them, how to use them, and the decision-making process, which we call the SIGA model, and using them as well. There's a special chapter on combining income methods. We saw one of those today. On the BABA position, we showed a combination of 4 and 1, how even though you might have wanted to sell the call to see premium coming in, you could put yourself in a better position by manipulating that second asset and still have the ability to sell the call against your protected position and even further lower the risk to bulletproof it as well. And there's also several appendices, including chart reading, income method decision table, and a lot more. Now, the blueprint, as you saw on the last page, is $339 for the blueprint. But there's a special bonus page you can go to. I'll send it to the chat window, but it's right there. It's radioactivetrading.com/iridium. Okay, let's send that in the chat window. There we go. So radioactivetrading.com/iridium. Now, if you pick up the blueprint, we're going to send you what's called the Quick Action Guide. It's about a 12-page white paper that Kurt put together to help you get started more quickly with the blueprint and the radioactive trading techniques. There's a series of Mastery Series CDs that Kurt put together, Mastery CDs that Kurt put together that go through the income methods in video format, similar to what you're seeing today, but much more in depth, covering income methods, the beginnings, 1 and 2, profiting with puts, income methods 3 and 4. So there's 6 total discs. If you pick up the blueprint today, it's a special link. We'll send you the first disc, the Foundations of Radioactive Trading, free, which usually goes for $89 as an individual price. We talked about Fusion. We showed the open trades on Ernie's portfolio and Greg's portfolio. We also looked at the RPM report, but there's other tools and lessons that Kurt put together to help you master the radioactive trading techniques. The third bonus you get if you pick up the blueprint at the Iridium page here is you'll get your first month of Fusion for only $10. So you save $59 there. You'll also get a free month of Power Options, which we didn't get to take a look at today, but the profit and loss charts I was showing you, plus the patented search tools for over 23 different strategies from the get-go, but also the married put, the default criteria for the radioactive trades or the married put search. You get a free month of Power Options. And you don't have to start those right away. These two here, you'll receive the Fort CD and the Quick Action Guide with your blueprint shipment, but these two here you can start at any time. You can wait 2 weeks. You can wait 3 weeks after you receive the blueprint or more, and then activate your first month of Fusion when you're ready, or activate your first month of Power Options when you're ready. They'll still be available even if you wait 12 months from now. In addition to that, everyone who picks up the blueprint, of course, does have free email support and free phone support at RadioActive Trading and with Power Options, but you'll also be able to schedule a free coaching session, 45 to 50-minute phone conversation with myself or with Ernie if you pick up the blueprint as well. But it's no risk to you. We talked a lot today about bulletproof position and having no risk. Well, the blueprint is no risk to you. If you pick up the blueprint at the Iridium page, radioactivetrading.com/Iridium, to get those special bonuses today or even this weekend, we also offer a money-back guarantee. When you receive your blueprint, you start going through it, and for whatever reason you feel it's not for you, that maybe it is too complicated as well, even though it was written out by Kurt to be as simple as could be, to give you the ideas, but not get caught up in the terminology of delta and implied volatility and and all of that, in the money, out of the money. He discusses it as far as the position goes, the do's and don'ts that you want to set up to make it easy to understand, even for those of you who have never researched or studied options before. Okay? But if you're not satisfied with it for any reason after you start going through it, send it back to us and we'll refund your purchase price, no question asked. It's no risk to you at all. It's sort of a bulletproof offering up front to where it's no risk to you, but you still have the potential, of course, to change your trading from what you saw last year, even in the next 12 months going forward. If you're wrong more often than right, you could still potentially make money. We illustrated that with the Trade Simulator tool as well. Blueprint owners also receive access to our members-only webinars. On the RadioActive Trading site, you'll be given a password that you can log into a free registration account, and you'll be able to access the 8 or 9, actually I think there's about 12, members-only webinars and white papers. And once every 30 to 45 days, we host new ones. Now, I apologize for this. Ignore this. That's my fault. This one here, I copied and pasted from an old webinar. We did one back in September, members-only webinar, which is archived. So if you pick up the blueprint, you'll still be able to access it. And that was on the 12 different income methods, about a 2-hour presentation review with the 12 different income methods, when you consider using one over the other in different scenarios. Okay, but you can only get the members-only webinars if you pick up the blueprint or the home study kit as well. All right, so questions? Well, if anyone has any last-minute questions, there's still a couple there I promised I'd go through, but if you have any last-minute questions, go ahead and send those in. Remember, you can also email us anytime to support@radioactivetrading.com. You can also reach us at the office at 302-992-7971. If you live in the U.S., you could reach us at 877-992-7971. Okay, and I'm sorry, Ben's question was, can you speak to the IV risk of the strategy, perhaps emitting high IV stocks or selecting low IV rank stocks? Ben, you don't need to. I'm going to do something real quick here that I normally don't do. Now, we've done it before, but we didn't really want to get into it too bad. But it's okay. I'm actually going to go to powerop.com, and I want to show you something. The reason why I'm going to Power Options instead of back to RadioActive Trading is that on Power Options, we can adjust some of the criteria, but we can also change the dynamic of the data that we're seeing. Okay? So, let's go here. Let me change my screen, folks. There we go. Okay, so this is the standard Power Options subscription. I'm going to go to Married Put, and I'm going to search. There's a patented search tool in all 23 strategies that we support. Now, as I mentioned, when you take that trial, you get your free month of Power Options. When you go to Married Put and you click on Search, you'll see our default criteria listed here. We've programmed it in. These are the same list that I will use today or next week to open a new radioactive trade. I'll take it from one of these particular lists here. I'm sorry, one of these particular stocks here as well. Okay, so Ben's question, can you talk about high IV stocks versus low IV stocks? Well, there's a trade-off. If you follow the rules in the blueprint and the discussion of how to properly set up the structured trade, there's 3 things you're already doing. You're already sorting by implied volatility. You're already sorting by delta, even though I'm not using any implied volatility or historical volatility filters in the search for my new married puts, and I'm not using any delta or gamma or theta. or Vega. I'm not using any of that because the structure of the trade dictates that all of my married put positions are probably going to be between a delta of about maybe 0.5 to about 0.65, maybe 0.7 on the high side. Okay? What does that mean? That also means, let me go ahead and add some columns here, and add the implied volatility. I'm going to add the percent implied volatility range, total range of the put option, and I'm going to put in the historical volatility as well, I think, or maybe I won't, but let's go ahead and stock index volatility also, IV over HV as well. Okay, so let me go ahead and add those in for you. All right, so here's our wide ranges of implied volatilities. What do you notice? The highest one is at 0.4835. I think this is my winner here. The lowest one is 0.228. But I'm not using any implied volatility filters on the position. So even here, we've restricted the implied volatility by looking at a proper structure. Looking for the stock criteria that we use, I have limited this already to a reasonable range of volatility on the stock about the same range. Now, one thing I would say, this is percent implied volatility range, showing us where the implied volatility of the put option is over the life of the option. I'm probably avoiding anything that's above 80%. There's discussion of that on some of the archive webinars for Blueprint owners as well. I'm probably avoiding even these ones at 76 and 73% and look for a lower range. Okay, but this IV over HV, I just pulled it up to show you. I don't even care about this. Okay, I don't care if the market thinks the put that I'm buying for insurance is overvalued or undervalued based on their expectations. What I care about is, am I in the risk threshold I want on a stock that I'm neutral to bullish? All of this here is taken care of if you follow the rules, the proper structure that's discussed, and the criteria in the search tool. You don't even need to worry about any of that. If the implied volatility was too high, the put price would be too high, and the risk would be outside the single-digit range that we want. If the implied volatility is too low, then the risk would be too low. There is such a thing, remember I said, as taking too much of a risk. I can buy a put that's almost 40 or 50% in the money and only have a risk of 0.3%. But now my expectancy of profit is going to be about 0.3%. Okay, so you can hedge yourself out too far. And that's all discussed in the blueprint. In addition to that, these other criteria that many options traders, some options traders, and those of you that were just trading stocks now, and maybe have been turned off by options because you hear these archaic terms or these special terms of delta, gamma, theta, delta neutral, gamma decay, gamma neutral, gamma ratio, implied volatility, IV over HV, IV over SIV, all those other things. This is a properly structured trade where when set up correctly, following the rules that we've spelled out for you, none of this even applies. It's not even necessary. So if that one little twinge maybe I mentioned about the percent implied volatility range, that's discussed as well. Okay, so if you want to take a higher risk, Ben, you can look for positions. You can customize that search any way you want to find your unmarried puts. You could look for positions with a higher historical volatility that show more movement, but you're going to pay more for the put. Your risk's going to be around the 12 or 13% range, maybe 15 or 18% range, but you can do it. I have open positions on low volatility stocks, dividend paying stocks I was bullish on, and even though the risk was low because the volatility was low, it didn't look like the stock was going to move. Johnson & Johnson was one of them from a couple years back that I rode from 70 up to about 95 over a 6.5-month period. Okay, so I was able to close it for a double-digit gain of around 14% over a 5.5-month period, which would have outperformed what I could have gotten with covered calls on that position as it was moving up in price as well. Okay. All right. So Ben says, is this position archived? Yes, we did record this position. Wow. Sorry, Ben. I did record this presentation. It'll be posted today probably around 4:30 p.m., 5 p.m. Eastern Time. You'll probably receive an email actually around 5:45, 5:30 p.m. Eastern Time. Where is it going to be located? Well, you can see even our other archive webinar. Let me go back here, make sure it comes through, that I selected the right screen. Fantastic. So if you just go to radioactivetrading.com, let me go ahead and sign out. Remember, if you go to radioactivetrading.com, if you click the Resources tab, well, you can get a 14-day free trial to Power Options, but you can also run that trade simulator tool to run your numbers. If you click on the free webinars tab, you'll see a webinar we did last week. This spread trade pays you twice, one of the other 12 income methods. You can watch that. But this is where the webinar is going to be posted. Right here today, you'll see what is possible with radioactive trading. And again, that'll be posted, Ben, probably around 4:30 p.m. Eastern time. Okay? But you might not receive an email at 5:30 because I do have another webinar this afternoon as well. All right, so ladies and gentlemen, one last time, what to do next? Well, I think we've answered all the questions. As I mentioned, this presentation will be recorded and you'll receive an email there. Go to radioactivetrading.com/iridium. If you're serious about using those 12 different income methods, if you're serious about limiting your risk, and if you're serious about seeing your next year's trading be winning as opposed to maybe 50-50 and muddling, or perhaps losing even though you picked more winners, got to start controlling your risk to single digits. Pick up the blueprint and see how to do it. It's no risk to you. Remember, it comes with a money-back guarantee plus those other bonuses. Remember, the link is radioactivetrading.com/iridium. Well, Stan and Ben, of course, Martin, thank you all for your questions. Thank you, everyone, for joining me today. We hope to see you soon at one of our upcoming radioactive trading presentations. We will have one next Tuesday as well, and you'll receive an invite to that one as well before the Thanksgiving break, but you'll receive that as well. Take care, everyone. Have a great Standard Friday expiration, I guess, for November, and we'll see you soon. Good night.